Welcome to today's deep dive. I'm so glad you could join us today because we actually have a custom-tailored journey planned just for you.
Yeah, it's a really exciting one.
It really is. If you've been paying, any attention at all to the financial world lately, or even if you're just casually scrolling through your phone on the couch, you have probably noticed this massive trend that's just taking over Wall Street right now.
Oh, it's everywhere.
It is. We are talking about the sudden, seemingly overnight rise of prediction markets. It really feels like they are suddenly dominating the entire conversation. But the mission for our deep dive today is to basically cut through all that noise. We want to get past the flashy headlines and answer the ultimate question for you. Should you actually invest your hard-earned money into this hype?
Right, because it is incredibly easy to feel totally overwhelmed by the information overload when a new investment fad hits the scene.
Oh, absolutely.
One day you have literally never heard of a concept, and then the next day, everyone on social media is suddenly a financial expert on the quote-unquote next big thing. But if we connect this to the bigger picture, today's deep dive is really about much more than just prediction markets themselves. What we are really going to do is use this current frenzy as a masterclass in understanding the psychology of Wall Street hype cycles, and more importantly, how you can actually protect yourself from them.
Okay, let's unpack this because before we get too deep into the psychology, we need to establish exactly what prediction markets are and, why they are officially red hot right now.
Good point. We need that foundation.
Right. So for those who might not be super familiar, a prediction market is essentially a platform where you can buy and sell shares based on the outcome of real-world events.
Basically betting on the news.
Exactly. Instead of buying a share of Apple because you think they'll sell more iPhones, you're buying a contract that pays out if a specific event happens. That could be a political election, an inflation report, or even who will win the Super Bowl.
Right.
And right now, we are seeing major established mainstream companies completely pivoting their strategies to get a piece of this action.
And that pivot, that is the critical signal we really need to pay attention to.
Yeah.
I mean, it's one thing when a niche crypto platform experiments with event contracts in the background. It is entirely different when the big traditional players step in.
Right. And the players stepping in right now are massive. DraftKings, a company that is normally known purely for its sports betting business, is actively working to expand into prediction market.
Which makes sense for them.
It does. They clearly see this as the next logical evolution of gambling.
Mm-hmm.
But it's not just the sports betting world. The discount broker, Robinhood.
Wow, yeah, Robinhood.
Yeah, Robinhood is now offering prediction markets directly to its customers. I want to ask you about this. If giant established platforms like Robinhood are adopting this, doesn't that mainstream validation mean the risk is actually lower this time? I mean, kind of feels like the Wild West phase is over.
It is very tempting to think that way. I completely get that logic. When a platform like Robinhood, which caters to millions of everyday retail investors, starts offering a product, it absolutely changes the game.
Yeah, it mainstreams it.
It completely normalizes the behavior. Like you said, this is no longer a fringe internet concept discussed on niche forums. It has totally hit the mainstream. But to address your point about the risk,
Right.
Mainstream validation absolutely does not lower the investment risk. In fact, historically, it often acts as a giant beacon flashing that the market is reaching a total fever pitch.
Oh, interesting.
Yeah, when everyone has easy tap of a button access to a trend, the valuations tend to completely detach from reality.
That makes a lot of sense.
Yeah.
And that mainstream validation is actually the central catalyst for what we are discussing today.
Right.
Because of all this heat, rumors are absolutely swirling right now that Polymarket, which is arguably the biggest name in this space right now, but still a privately held company, is eyeing an initial public offering, or IPO, in 2026.
Oh, that's the big rumor.
The whole financial world is just waiting with bated breath to see if they're going to make that leap onto the public markets.
And it is crucial to understand exactly why this is happening right now. Like in this specific moment, Wall Street banks are highly likely in deep talks with Polymarket as we speak.
Oh, I'm sure their phones are ringing off the hook.
Without a doubt. You have to remember how Wall Street actually makes its money. They earn massive fees by underwriting these IPOs.
Right.
The banks understand the mechanics of market enthusiasm better than anyone else on the planet, and they know that they need to strike while the iron is hot.
Strike right now.
Exactly. It would make total strategic sense for a privately held company like Polymarket to act right now. If they wait too long, If they wait for the novelty of prediction markets to wear off, this window of opportunity to raise billions of dollars could just close forever. Market sentiment is incredibly fickle.
Here's where it gets really interesting. To truly help you, the listener, wrap your head around this whole Polymarket situation and what it might mean for your money, we need to look at a brilliant historical comparison.
I love this part.
We need to look back at the electric vehicle, or EV, gold rush from just a few years ago.
Yeah.
If we look at the Tesla story, it is just the perfect parallel to what we are seeing right now.
It really is the perfect analogy. Tesla was the trailblazer. They were the very first publicly traded company to exclusively build all-electric cars.
Right.
And by doing that, they proved that there was actual, genuine consumer demand for the product.
But if you remember those early days, it was anything but a smooth ride for them.
Oh, it was brutal.
Tesla bled red ink for years. They went through what Elon Musk famously called production hell.
Yes, production hell.
They were losing money year after year, constantly teetering right on the brink of bankruptcy, before they finally achieved scale, proved their model, and became a sustainably profitable business. They basically did all the agonizingly hard work to prove the EV sector was viable.
What's fascinating here is the domino effect that followed once Tesla actually succeeded.
Okay.
Once Wall Street finally got truly excited about Tesla's success and watched their stock price absolutely skyrocket, the floodgates opened entirely.
You're stupid.
Completely. Suddenly, private electric car makers that literally no one had ever heard of came out of the woodwork looking for cash. They saw Tesla's massive valuation. They saw retail investors desperate to find the next Tesla, and they wanted in on that capital.
And the sheer volume of money that was raised during this specific window of opportunity was just staggering.
Unbelievable amounts.
Companies rode that exact wave of EV enthusiasm, bringing in incredible amounts of cash before they had even sold a single car. Rivian and Lucid are the prime examples here.
Oh, absolutely.
They held their initial public offerings right in the middle of that frenzy, and retail investors threw billions at them, completely convinced they were getting in on the ground floor of a guaranteed revolution.
But here is the underlying Wall Street mechanism that you really need to understand to protect your portfolio. This cash grab that we saw with electric vehicles wasn't a unique event.
It wasn't a one-off.
Not at all. It was not some once-in-a-lifetime anomaly. It is a repeating, highly predictable pattern. When an emerging sector becomes in vogue on Wall Street, young companies inevitably line up to IPO.
Yeah.
It is a classic move. Wall Street packages the hype, sells the dream to retail investors, and the companies walk away with a massive influx of cash.
When you look back at recent market history, the list of examples is just relentless. We saw this exact same rush with companies involved in small modular nuclear reactors.
Oh, yeah.
Suddenly, every single company with a blueprint for a tiny reactor was going public via specialized shell companies, promising to solve the global energy crisis tomorrow.
Right.
We saw with vertical lift short-haul electric aircraft, the VTOLs.
The flying
The
taxis.
flying electric taxis. It sounds incredibly futuristic, and they saw a massive wave of hype and funding despite the obvious looming regulatory nightmares that would come with flying taxis over cities.
You can't forget the marijuana industry boom either.
Oh, exactly. The green rush. Around 2018, when Canada legalized recreational cannabis, investors treated every single weed farm like it was going to be the next Coca-Cola.
They really did.
Valuations went completely through the roof, ignoring the realities of supply gluts and distribution bottlenecks. And of course, we are seeing this exact same script playing out right now with the current undisputed darling of the market, artificial intelligence.
Oh, definitely.
If a company simply adds .ai to their website, their valuation seems to just double overnight.
It is important to provide a balanced, nuanced view here, though. The businesses involved in these trends, whether it is vertical lift aircraft, electric trucks, or prediction markets, they aren't necessarily doing anything nefarious by going public during a hype cycle.
That's a fair point.
Building a startup company is brutally difficult, and tapping the public capital markets for cash is incredibly hard. So doing so when retail investors are eagerly lining up to throw their savings at a trend is just a complete no-brainer from the company's perspective.
Right, you take the money when it's there.
Exactly. It is the logical fiduciary move for their founders and early private investors. They need the capital to survive. But, and this is the crucial part for you listening right now, It poses a massive risk for the retail investor who is buying at the very top of that hype cycle.
Which brings us to the most practical question for our listener today. So is it actually worth buying into prediction market companies like a potential Polymarket IPO when it inevitably hits the market? Should you be the one buying those shares on day one?
If history is any guide, the sobering reality is that the answer is likely no.
No.
The odds are heavily, heavily stacked against you.
Let's bring the receipts to prove exactly why that is the case, pointing right back to that EV hype we were just talking about. Rivian and Lucid went public to absolute fanfare.
They were on every magazine cover.
They were the undisputed darlings of the financial media. But if you look at them today, their stocks have declined dramatically since those IPOs. They're currently sitting far, far below their high watermarks. The dream just collided with the reality of mass manufacturing.
The financials of those companies today tell a very stark story of what happens when the initial hype fades and the brutal reality of running a capital-intensive business sets in.
I want to share a specific jaw-dropping statistic that perfectly illustrates this. I mean, this is wild. Lucid Group's current gross margin is sitting at an astonishing negative 9,280.51%.
That is just a devastating number.
Let's translate what that actually means in the real world for you. That means for every single dollar Lucid brings in from selling an electric vehicle, they're spending nearly $93 just to build the thing.
Wow.
And that doesn't even include marketing or administrative costs or long-term research. It costs them $93 in raw materials and factory labor just to generate one single dollar of revenue. It is an absolute cash bonfire. That is the reality behind the IPO fanfare once the dust settles.
And that staggering negative margin is just one piece of a much larger cautionary tale. It's not just that these companies struggle to make a profit. Many of them completely vanish. We are talking about a veritable graveyard of EV bankruptcies. Look at companies like Fisker, Nikola, and Lordstown Motors.
Nikola is such a great example of this. They went public with a massive valuation before they even had a working product.
Right.
And they were famously caught rolling a prototype truck down a hill just to make it look like it was driving under its own power in a promotional video.
Unbelievable.
Or Fisker, who outsourced their manufacturing and ended up with cars plagued by software glitches and production delays until the cash completely dried up.
They all rode that initial wave of excitement. They all capitalized on the fact that investors wanted an EV stock, any EV stock, to put in their portfolio. Yeah. But they ultimately collapsed because the fundamental business just wasn't ready. And this points to the core thesis of how Wall Street operates during a boom. Far too often, companies go public long before they're actually ready. They rush the process simply to capitalize on investor enthusiasm for a specific theme.
You have to get that cash while the window is open.
Precisely. But over time, the market is ruthless. It stops caring about the narrative and starts demanding actual profits. And when that happens, the weakest companies are brutally weeded out.
So what does this all mean? We've talked about EV failures, massive negative margins, and Wall Street underwriting fees. How do we distill all of this into actionable wisdom for you, the listener, as you watch prediction markets take over the news cycle?
It is entirely about separating the success of a business concept from the mechanics of an IPO. Clarifying this distinction is essential. Deciding to avoid the IPO doesn't mean that Polymarket or any other prediction market won't eventually be a highly successful, enduring company.
Right.
They might genuinely revolutionize how we forecast the news. It simply means that getting caught up in the IPO hype machine is historically very dangerous for your portfolio.
Definitely.
When you buy into an IPO during a hype cycle, you're almost always paying a massive premium for the excitement, not the actual underlying value of the business. The better, much sounder long-term investment decision is almost always exercising patience. You wait to buy until after investors have lost interest, the headlines have faded, the hype premium has washed out of the stock price, and the company has actually proven it can operate a profitable business.
To really drive that point home, we can contrast the danger of chasing IPO hype with these staggering, undeniable numbers of true, patient, long-term investing. The historical data here is just incredible. Let's talk about holding on to companies that have proven their value over decades, completely ignoring whatever the hot fad of the day happens to be.
Real wealth builders.
Exactly. If you had invested $1,000 in Netflix back in 2004 and simply held on to it through the 2008 financial crisis, through the pandemic, through every single market panic, that investment would have grown to over $519,000 today.
And the patience required to hold through all of that volatility is the hardest part of investing, but it is exactly what generates real wealth.
Exactly. Or look at NVIDIA. If you put $1,000 into NVIDIA in 2005, back when they were just making graphics cards for hardcore PC gamers, that $1,000 would be worth over $1.08 million today.
Incredible.
Those massive, life-changing numbers prove that patience and finding true long-term value always beats chasing today's and vote cash grab. When you tried to time the next big IPO, you were essentially gambling against Wall Street insiders who hold all the cards. But when you invest in proven, growing businesses over the long term, you let compound interest do the heavy lifting for you.
It really puts the fleeting nature of these hype cycles into perspective. Chasing the hot new thing feels exciting, but excitement is rarely a good investment strategy. But before we wrap up today, I want to leave you with a final lingering thought to mull over, specifically regarding prediction markets.
Let's hear it.
If the entire premise of a prediction market is to accurately forecast future events based on the collective wisdom of the crowd, what does it say about human psychology that this exact same crowd is completely blind to their own inevitable IPO hype bubbles?
Oh, well.
Can a prediction market ever accurately predict the crash of its own hype cycle?
Now, that is a beautifully mind-bending paradox to end on. If the crowd is so smart, why do they keep falling for the exact same Wall Street tricks? I appreciate you leaving us with that to think about, and thank you so much for joining us on this deep dive today. We hope you walk away feeling a little more prepared to navigate the headlines, ignore the noise, and protect your portfolio from the hype. We will see you next time.